Have you ever wondered why your grandparents could buy a house for the price of what a used car costs today? Or why a cup of coffee seems to get more expensive every single year, even if the coffee itself hasn't changed? It feels like a magic trick, but a very cruel one, where the money in your pocket slowly dissolves into thin air. This phenomenon is the single most important economic force shaping your life, yet it is often the least understood. We are talking about inflation. To understand inflation, we have to stop looking at money as a fixed thing. We tend to think that a dollar is a dollar, or a euro is a euro, just like a meter is always a meter. But money is not a constant unit of measurement. It is a commodity, just like oil, wheat, or gold. And like any commodity, its value depends entirely on supply and demand. When there is too much money chasing too few goods, the value of that money drops. This is the classic definition of inflation, a general increase in prices and a fall in the purchasing power of money. But let's dig deeper. Why does this actually happen? Economists generally distinguish between two main types. First, there is demand-pull inflation. Imagine an economy is booming, everyone has a job, wages are rising, and people are spending confidently. Suddenly, everyone wants to buy a new car or renovate their house at the same time. Factories run at full capacity, but they simply cannot produce enough goods to meet this surge in demand. So, what do businesses do? They raise prices. This is often described as too much money chasing too few goods. It is a sign of a hot economy, but if it gets out of control, it burns everyone. Then there is the second type, which is far more insidious: cost-push inflation. This happens when the cost of production itself goes up. Imagine a major geopolitical crisis cuts off the world's oil supply. Suddenly, it costs more to transport food, manufacture plastics, and power factories. Companies aren't raising prices because people are buying more. They are raising prices because they have to protect their profit margins just to survive. This is painful because prices go up, but the economy isn't necessarily growing. In fact, it might be shrinking. This leads to a nightmare scenario called stagflation, where you have high inflation and high unemployment at the same time. But there is a third player in this game, perhaps the most powerful of all: the money supply. Throughout history, governments have turned to the printing press to solve their problems. Whether it was the Roman Empire diluting the silver content of their coins, or modern central banks engaging in quantitative easing, the principle is the same. When you inject massive amounts of new currency into the system without a corresponding increase in the goods and services produced, you dilute the value of every existing unit of currency. It is simple math. If you double the amount of money in the world overnight, but the number of houses and apples remains the same, eventually the price of houses and apples will double. If you are enjoying this deep dive into how the economy actually works, make sure to hit that subscribe button right now. We decode the financial world so you can make smarter decisions with your money. Don't let inflation eat your savings. Join our community and stay ahead of the curve. Now, let's talk about why this matters to you specifically. Inflation is often called the invisible tax. You don't see it on your pay stub, and you don't file a return for it at the end of the year. But it taxes you nonetheless. If you keep your savings in cash under your mattress or in a low-interest bank account, you are effectively losing wealth every single day. Let's say inflation is running at 5%. If you have $10,000 in savings, in 1 year, that money will only buy what $9,500 buys today. You haven't spent a dime, yet you are $500 poorer in real terms. This psychological aspect is crucial. Inflation changes human behavior. When people expect prices to keep rising, they spend their money faster. Why wait to buy a refrigerator next month if it's going to cost 10% more? This creates a self-fulfilling prophecy. The faster people spend, the faster money circulates. Economists call this the velocity of money, and the higher prices go. It creates a feedback loop that can spiral out of control if not checked.
So, how do we stop this train before it crashes? Enter the central banks, like the Federal Reserve in the United States or the European Central Bank. These institutions have a dual mandate: to keep unemployment low and to keep prices stable. Their main tool for fighting inflation is interest rates. Think of the economy as a car and interest rates as the brake pedal. When inflation gets too hot, the central bank steps on the brakes by raising interest rates. This makes borrowing money more expensive. Mortgages go up, car loans get pricier, and business loans become costly. The idea is to cool down spending and investment, reducing demand so that prices stabilize. However, this is a delicate balancing act. If they slam on the brakes too hard, the car skids off the road, meaning the economy goes into a recession. People lose jobs and businesses close. This is why you often hear news anchors talking about a soft landing. They are hoping the central bank can slow down inflation without crashing the economy. It is rarely a perfect science. History is littered with examples where this balance failed. We cannot discuss inflation without mentioning its terrifying big brother, hyperinflation. This isn't just prices going up, this is currency dying. The most famous example is the Weimar Republic in Germany in the 1920s. The government printed money to pay war reparations, and it got so bad that people were using wheelbarrows of cash just to buy a loaf of bread. Waiters would stand on tables in restaurants to announce new prices every 30 minutes. More recently, we saw this in Zimbabwe and Venezuela. Hyperinflation destroys society because it destroys trust. Money is essentially a system of trust. When that trust evaporates, the social contract breaks down. But let's step back from the apocalypse scenarios and talk about practical solutions for you. In an inflationary environment, holding cash is a losing strategy. So, where does money go to hide? Historically, investors turn to hard assets. Real estate is a classic hedge. Land is finite. They aren't making any more of it. As the currency devalues, the nominal price of property tends to rise. Furthermore, if you have a fixed-rate mortgage, inflation actually helps you. You are paying back the bank with money that is worth less than when you borrowed it. Another traditional hedge is gold and commodities. Gold has maintained its purchasing power for thousands of years. An ounce of gold in Roman times bought a nice toga and a belt. Today, an ounce of gold buys a nice suit and a belt. It preserves wealth, even if it doesn't always generate massive profits. Then there is the stock market. Over the long run, owning pieces of productive companies is one of the best ways to outpace inflation. Companies can raise their prices to match inflation, passing those costs on to consumers, which protects their earnings and, by extension, your investment. Of course, stocks are volatile, but leaving money in cash is a guaranteed loss in purchasing power. In the modern era, some people argue that cryptocurrencies like Bitcoin act as digital gold because they have a fixed supply cap, unlike fiat currencies which can be printed infinitely. While this is a newer theory and comes with high volatility, it represents the same desire, to opt out of a system where money constantly loses value. Ultimately, understanding inflation is about understanding that stability is an illusion.
The economy is always moving, shifting between inflation and deflation, growth and recession. You cannot control what the central banks do. You cannot control geopolitical supply shocks. But you can control how you position yourself. By moving your assets from depreciating currency into productive value, you build a fortress around your financial future. Knowledge is the only asset that inflation cannot erode. If you found value in this video, do not just watch it, act on it. Check the link in the description for our top recommended resources on investing during high inflation. We have curated a list of tools and books that will help you navigate these turbulent waters. Don't forget to like, comment with your thoughts on the current economy, and subscribe for more deep dives. See you in the next video.